Hello and good day subscribers. Welcome to Moementum channel. Today we're going to talk about the banking stocks. We're going to review the largest three banks in the United States, Canada and Australia, analyze their stocks and compare them to each other and decide which one is a better buy for you right now in the stock market. So let's get into it. The criteria that we will use to evaluate these stocks include their revenue and net income growth, dividend history and the dividend safety of the stock, and the stock's valuation in terms of different number of key metrics that we would like to review together. So the largest banks in terms of total assets in 2020 are as follows. In the US, the top of the list is JP Morgan Chase with $2.69 trillion in assets, Bank of America with $2.43 trillion, and Citigroup with $1.95 trillion. In Canada, the largest bank is Royal Bank of Canada with $1.08 trillion, followed by Toronto Dominion Bank or TD Bank at $1.04 trillion in total assets, and Bank of Nova Scotia with $824 billion. And lastly, in Australia, the largest bank in terms of total assets is Commonwealth Bank of Australia with $686 billion. Australia and New Zealand Banking Group Limited is the next one with $662 billion in assets. And lastly, Westpac Banking Corporation with $612 billion in assets. All right, so let's get into the criteria that we've set forward and review these banks in terms of their potential. As for revenue growth for the US banks, you have here on the list, and we are taking a look at their financial reports. And what's really important for me when analyzing these stocks from a revenue perspective is how the revenue is changing over time. If I'm looking at a healthy company, I would like to see a growth in the revenue year after year. Of course, it's understandable that there might be certain fiscals, like the situation that we are currently facing in the economy, but overall, if the company has the potential and has the grit and has done the work to be able to navigate through those difficult times and grow their revenue, it's really a good sign for me. So looking at the US companies here, JP Morgan Chase, you could see here, for the most part, their revenue is growing year after year. The last column is showing you the trailing 12 months. So if you look back at the past 12 months for this company, how are they doing in terms of the revenue? So all in all, JP Morgan is doing very well. Only the trailing 12 months is where you can see that the revenue has declined by 2.38%. As for Bank of America, you see a steady growth as well. 2016 compared to 2015, you have 0.38% increase, followed by 4.53% increase compared to the previous year. Again, another 5.66% increase compared to the year before. But 2019 is where they struggled. In fact, the revenue went down based on their financial reports in December 2019 by 3.26%. So a little bit of red flag for me there. Similarly for Citigroup, there is a little bit of red flag there. For 2016 December, their revenue went down by 7.5%. And also the trailing 12 months, they are showing some decline in the revenue. Now let's take a look at the largest banks in Canada and how they are doing in terms of the revenue growth. At the first glance, I really like what I'm seeing because you can see across the board, the revenue has been steadily growing over time. Now keep in mind, the fiscal calendar might be different from one country to another or even from one organization to another. But for the banks here in Canada, the fiscal month is actually October as opposed to December for the ones that we just saw for the United States banks. Very healthy growth here for Royal Bank of Canada, 6.26%, followed by 10%, another 2%, another 6.89%. And the best thing of all, the trailing 12 months, still they are showing an increase. That to me is very impressive. It just shows that this bank and the rest of the banks here on this slide are doing things right. They are able to grow their revenue steadily year over year. The banks that really stand out for me here is Royal Bank because their trailing 12 months is just impressive, 7.88% in terms of revenue growth, followed by Bank of Nova Scotia with 5.89% growth. Now, in order for us to be fair so that we can compare apples to apples, we made sure that all the figures here discussed in terms of the dollar value are actually in US dollars. So you're using the same currency so that there is comparability for these stocks, and they're all from the same sector, from the banking industry. Now, let's move on to the Australian banks. A number of red flags, of course, as we see here. Look at Commonwealth Bank of Australia. There are a number of red percentages here showing that the revenue is actually declining. 2016 went down by almost 4.5%. Then they had a spike back up, but again 2018, 2019, and the trailing 12 months is going down. Similar story across the board for ANZ Bank, and also for Westpac Banking Corporation. Now, the ANZ and Westpac Banking Corporation are probably struggling the most because if you look at their revenue growth in the past 12 months, the trailing 12 months, they are down by over 20%. Let's move on and take a look at the different metric. Here we are talking about net income. So while revenue and the revenue growth is very important, you cannot just focus on that without looking at their company's net income, because net income is a measure for the profitability of the company. The company might be making a lot of money through revenue, but at the same time, their cost might be so much that they are, at the end of the day, they are maybe loss making. So we want to make sure that we do not forget the net income. Now, going back to our US banks and how their net income has evolved over the years, you can see for JP Morgan, overall, it's very positive. If you look at particularly for December 2018 compared to December 2017, they had a massive increase of 32.87%. But there are a number of reds there as well. So the trailing 12 months is actually declined by 8.57%. Somewhat a similar story for Bank of America and Citigroup. The Bank of America, their trailing 12 months net income has gone down by 15.46%. And for Citigroup, this net income has gone down by 5.08%. Look at Royal Bank of Canada and Toronto Dominion Bank. Their net income is growing steadily, 2.29%, 14%, 6.33%, 3.65%, and the best part of all, actually their trailing 12 months still growing, 4.20% for Royal Bank and 7.57% for Toronto Dominion Bank. The Bank of Nova Scotia, or as we sometimes call it, Scotiabank, is struggling a little bit. You can see that in October 2019, the net income went down by 1.91%, but aside from that, their numbers are quite solid. Now let's take a look at the banks in Australia and how they are doing for net income. A number of reds on the screen, not definitely something that you would hope. The ANZ and Westpac are doing again poorly in their trailing 12 months. Look at that. ANZ, their net income trailing 12 months has gone down by 40%, and for Westpac, this is even worse by 41%. Now, we're going to shift gears and take a look at the dividends for these companies. For me, as a dividend stock investor, I would love to see a company that is strong in terms of their fundamentals, is a strong company in terms of the valuation, but on top of that, they pay a dividend, and their dividend payout is at a healthy ratio. So I'll explain further as we get into it. As for the US banks, JP Morgan, their dividend yield, their forward dividend yield is currently sitting at 3.88%. Bank of America is sitting at 3.05%, and Citigroup is sitting at 4.40%. JP Morgan Chase, their dividend payment goes back to 1996. Bank of America 1999, and Citigroup 1998. So roughly in late 90s they started paying their dividends. One thing that I want to point out, and something that I really look into as I discuss whether the company is a healthy company in terms of their dividend payment, it's their dividend payout ratio. Typically for a dividend paying company, I would like to see numbers between 20% to 60%, 60% being at the higher end of the range. So usually as it gets closer to 60%, it starts to show some red flags, but anything beyond that is not really as healthy for me. Now, if you look at the JP Morgan Chase, their payout ratio is 67.59%, so definitely more than 60%, and this is not really as healthy for me. What it tells me is that they are spending over 67% of their net income to pay for the dividends to the shareholders. Well, this is very generous of the company. That just means that it's not very healthy for them in terms of the opportunities for growth, in terms of having enough cash to grow the business and grow their revenues and expand and over time have new businesses and new markets. Definitely not a good payout ratio for JP Morgan here. Bank of America is doing better. Their payout ratio at close to 47%. And as for Citigroup, again, this is above 60%, currently sitting at 62.72%. You also have a couple of other columns that gives you a little bit more details in terms of their dividends. So, for example, for JP Morgan, they have grown their dividend in terms of the value of the dividend they've been paying straight for the past 9 years. Bank of America, they've grown their dividend in the past 6 years, and Citigroup has been consistently growing its dividend for the past 6 years. The 5-year growth rate is also important. It just shows you that if you compare the dividend payment for any of these companies in the past 5 years compared to today, how much is the difference between the amount of dividend that they pay. It's obviously a larger number. It's very interesting in I'll call it even juicy for the dividend stock investors, as long as their payout ratio is healthy and the fundamentals of the company is healthy. So don't fall for the trap of, if a company is paying really, really high dividend yields, to just assume that, oh, this is an excellent company to invest in because I'm getting really excellent return on my investment. That's not always just the case. You have to make sure that the company is healthy, the company is capable of sustaining those dividends over the long term. Otherwise, it's just a trap that a lot of amateur investors might fall for, and they're going to see their money be just thrown away, because who knows, sooner than later the company has no choice but to stop their dividend payment. That's just going to have a negative impact on the value of the stocks, and because they're not doing so well, it's going to have a downward ripple effect in terms of the company and its prospects. Moving on, as for Canadian banks, let's take a look at their payout ratio first. So Royal Bank of Canada, 51.71%, passed the criteria. Toronto Dominion Bank, 53%, and Bank of Nova Scotia, probably a little bit worse than their bunch, but it's still passing the threshold of 60%, sitting at 57.75%. The 5-year growth rate overall is very healthy for Royal Bank of Canada and Toronto Dominion Banks. They've been growing their dividend payments. As for Bank of Nova Scotia, they've actually declined the value of the dividends that they're paying. So it's not something that, as a dividend investor, you would hope to see. And all of these banks are actually paying dividends on a quarterly basis, and they've grown their dividends straight for the past 4 years. I mentioned the frequency of dividend payment because for Australian banks, the frequency of paying dividends for their banks is different. So here for Australian banks, they pay dividend on a semi-annual basis. In terms of the dividend yield, they are really high, which again, as I indicated earlier on, could be a trap for a lot of investors. If you think, wow, they're paying me 7% dividend, they're paying me 10% plus dividend. So this is just an excellent opportunity for me to grow my investment by investing in these companies. That's a good argument as long as the fundamentals of the company is solid. Take a look now at the payout ratio. For Commonwealth Bank of Australia, their payout ratio is at 69%, definitely above the threshold. But the ones that are really standing out here for me, like a red flag, are ANZ and Westpac. Not only they did almost terrible at their revenue growth and net income growth, but look at their payout ratio, 101% for ANZ and 156% for Westpac. This just tells you that these companies are paying out the entire net income that they're making back in terms of the dividend. And on top of that, they also have to have some debt to be able to support and service their dividend payments. Not a healthy sign at all, particularly for a bank. There's a different category of stocks. If you're talking about real estate investment trust, REITs, their business model is different because from a taxing perspective, they are required to pay very high payout ratios, typically higher than 80%. But for a normal company, as I indicated, like banks, paying out over 100%, it's not sustainable at all, which is why actually we are reading in the news that some of the Australian banks are actually strongly considering stopping their dividend payments. Now, all the metrics that we discussed are excellent in the sense that they allow us to understand how these companies have done in the past, how healthy their business is being run, but they don't tell us much in terms of the valuation. So you might have an excellent company out there that is really doing fantastic, but when you want to go and buy the company, they might be overpriced, they might be overvalued. So you don't want to buy them at the wrong time when they're actually, the price tag for the company is super high. This is something that we're going to address at the valuation section. So we're going to take a look at a couple of key metrics that allow you to understand whether these companies are valued at this time favorably, so that it's the right time for you to pull the trigger and buy into these stocks. The top row of this table actually provides you the sector median. So this is a good way for us to kind of compare where do these companies stack up versus the rest of the companies and banks in the banking sector. As for PE ratio, which actually is your price to earnings ratio, we have two types of them. We have the PE for the trailing 12 months, and we also have the forward PE. So the forward PE ratio, as you can read from the screen, actually divides the current share price of a company by the estimated future earnings per share. So has a little bit of projection in terms of what we anticipate to be the future earnings of the company. Whereas the trailing PE ratio is a relative valuation multiple that is based on the last 12 months of actual earnings. It is calculated by taking the current stock price and dividing it by the trailing earnings per share for the past 12 months. So looking into both of these metrics for PE allows us to make a stronger assessment where these companies sit for their valuation. I've also included here the price to sales value. So what is the price of the stock versus their total sales for the company? What is also their price to book value? So the book value denotes the value of your company's total assets. So after deducting all the costs. So if you look into their total assets minus all the liabilities, what's on the book, accounting books in terms of value of company. So if you can buy a stock as close or in fact lower than the book value of the company, I would say it's very good bargain, because if the company was to go bankrupt and they had to sell everything that they had, the difference, the book value, is still larger than what you paid to buy each share of the company in relative terms. So that's another metric that we're going to look at, and the price to cash flow is another metric for us to assess. The ones that are green denotes on this slide that they are doing better than the sector median, and the red ones just denotes that they are doing poorer than this sector median. Just because it's a red doesn't mean that it's a bad number. It just shows that it's not as good as what you see in the sector median. The ones that really jump out at me are the ones that have more green on the valuation slide. So if you look at it, the Canadian banks have a lot more green than the rest. As for the US banks, the Bank of America also kind of stands out for me. They are doing better in terms of their PE and their price to cash flow. And as for the Australian banks, the one that stands out a little bit more for me is the ANZ Bank. So their price to book value is sitting at 0.77, which is lower than sector median. And their price to cash flow is also 1.02, which is a lot less than sector median, currently sitting at 6.89. I want to also bring to your attention that all the numbers here are based on the GAAP, which is a generally accepted accounting principle. So this allows us to really compare apples to apples and ensuring that a similar accounting method has been used for calculating these numbers. Now, I had promised in the beginning of the video that I will share what would be my picks if I were to select any of these banks to purchase their stocks. Now, after going through all these metrics in terms of their revenue growth, net income growth, dividend payment, dividend health, and the valuation, I must say my picks would be the Royal Bank of Canada and the Toronto Dominion Banks. I'm definitely considering buying into these two stocks, and in fact I've put a limit price order to buy both Royal Bank of Canada and TD Bank. Now I really hope that you stick around for the next couple of minutes, because what I'm going to show you is going to blow your mind. Let's take a look at the dividend income from investing in some of these banks if you were to invest in them about 20 years ago. So we're going to take a look at the 20-year scenario, and I'm going to show you the power of the dividend growth over time. Let's say we bought into the TD Bank 20 years ago. 20 years ago, if you purchased it, the price per share was sitting close to $12.32. And at the time, as you can see in the notes, in the year 2000, TD Bank was paying approximately 44 cents in dividend, which was approximately 3.6% yield on that stock price of $12.32. What's fascinating is that over time, as TD Bank grew its dividend, imagine you already bought 10 stocks of TD at the time. Those same stocks would be earning you a yield of 18.27% per year just by holding on to those 10 stocks. Now you're earning 18+% per year in terms of dividend income. That's just impressive, and goes to show you the power of selecting the right companies and holding on to them for the long term. If you anticipate that their company is gonna do well and they're obviously gonna grow their dividend. Talk to me about this passive source of income. Look at the TD Bank here. It's just impressive. I have another example here for you as well. For Royal Bank of Canada, the situation is even better. If you bought their stock 20 years ago, you can see how your yield is currently sitting at 26%. Moving on, I have an example from Westpac, which is again doing very impressive. Here, if you bought their stock 20 years ago, the yield that you would get on their stock would be close to 16.68%. Again, very impressive return over the span of a 20-year. But not so good for the JP Morgan Chase. Look at that. If you bought their stock 20 years ago, their stock price at the time was $48, and the yield after 20 years is only sitting at 7.50%. Now, it's definitely much higher than the typical 3 to 4% yield, but it's nowhere close to the likes of 16, 26% or anything like that that you saw for TD, Royal Bank of Canada, or even Westpac. Now, I didn't, of course, go through all of these banks. I just handpicked a couple of them to show you the power of dividend and how it's actually important that you pick the right company. Otherwise, you don't want to just fall into the trap of picking any companies that pays a dividend and hoping that continuously you're going to make more and more money. There you have it, folks, an in-depth video comparing the largest banks in the United States, Canada, and Australia, and which one is a better stock to buy. I hope you enjoyed it. I put a lot of time and effort to prepare this video for you. In fact, it took me hours upon hours to actually research these companies one by one, put them succinctly onto a video and compare them, and at the end really tell you which one is a better stock to buy in my opinion. I really hope that you can like this video if you thought that you gained something of value, which I hope you did. Be sure to subscribe to our channel as well. Here on Moementum channel, we post weekly videos about stock market investing, finances, and personal development. Let me know what you think of this video. Do you have any banking stock in your portfolio? Which one of these stocks that we reviewed would you consider to buy? I would love to hear from you in the comment section down below. With that being said, thank you so much for watching, and I hope to see you next time.